in the financial to be a globally respected corporation that provides best-of-breed business solutions, leveraging technology, delivered by best-in-class professionals. The byline of the corporation, powered by intellect, driven by values, communicates this vision and this desire in a very elegant manner. But as I have said several times before, and I say it again, we are not very happy with our performance over the last 2 years. In the financial year 2012-2013, our growth rate was about 5.8% compared to the 11% for the Indian software industry. Of course, there was one company lower than us, but that's not much relief for the company that was time and again, year after year, voted as the best managed company, the most respected company, the best in governance, etc., etc. During the current year, we expect to be somewhere between 11.5 and 12% in our revenue growth, much more like 11.5 compared to what has been proclaimed as the NASSCOM industry growth rate by NASSCOM, and that is about 13%. The second matter of concern for us has been the coming down of our operating margin, which was 29.5% in FY11, and as of date, it is 23.5% for the current year. However, it went up to 25% during the third quarter of the current financial year. Now, this has to be looked at in the context that the rupee was somewhere around 44 rupees per dollar as of 31st March 2011, and then it went to somewhere around 54 or 55 as of 31st March 2013. And in fact, it went down to 62 or so as of 30th September 2013. Given that about 48% of our revenues get translated to Indian rupees, therefore, given that there was a devaluation of approximately about 25% in the rupee-dollar exchange rate, we should have added approximately about 12% to our operating margin. So therefore, under normal circumstances, our operating margin should have been 41.5%. But it ended up as 23.5% as of date, and that means it is a drop of approximately about 45%. So therefore, on the one hand, the revenue growth went down by 77% and the margin growth went down by 45% during the period 31st March 2011 and 31st March 2013. These are matters of deep concern for us as much as it is for you people. Therefore, we have set about an action plan to move towards better growth rate and better margins. At this point in time, I must make it very, very clear that there is absolutely nothing wrong with Infosys 3.0. Where we could have done a better job is in executing that strategy. So we said Infosys 3.0 is all about three strategic imperatives. First, deriving as much revenue as possible from large consulting-led transformational projects, which everybody in the industry all over the world has been aspiring to. Second, to de-link revenues from person-month efforts using products, platforms, and solutions. As you people know, given the requirements of infrastructure growth, given the requirements of hiring large pool of talent, every worthwhile company in the world would aspire to do this. That is, they want to de-link revenues from person-month effort. So there's nothing wrong with the second one. The third tenet of our strategy is to accept the adage that market determines the price and therefore the company has to determine the cost in a very competitive market that exists for large outsourced projects. In the first stream, our revenue last year was 33%, the highest in the industry. I am told that the next one is around 18%. So therefore, that part of the strategy worked very well. The second tenet of our strategy, which is products, platforms, and solutions, clocked about 5.5 to 6% of our revenue. This includes Finacle. So therefore, this strategy is still in its, this tenet of the strategy is still in its infancy and will take some time to fructify. But it is moving in the right direction. It is in the third tenet of our strategy that we need to focus more, because our growth rate went down because we were not as focused on large outsourcing projects, which are highly competitive and which require us to improve our cost base. So therefore, while the strategy was perfectly all right, the execution of the third part of the strategy is where we are now focusing more and more. Therefore, since June of last year, we have taken up 3 initiatives, which, as I have pointed out several times before, will take about 3 years before we can see visible results. First is the cost rationalization, cost optimization. We believe that for us to be effective in enhancing our opportunities in the third tenet of our strategy, we have to become more cost competitive. Therefore, we have to reduce our costs, which have gone out of whack, out of control. So I said it will take anywhere from 6 to 18 months before we can see visible results. But the good thing with this is that it has already started providing some visible results, and as we announced last quarter, our operating margin went to 25%, in other words, an increase of 1.5%. That's a reasonable progress. The second action item that we have taken up is improving sales effectiveness. Improving the quality of our proposals, hiring a large number of people who can beat the payment, building new systems, processes, and metrics, building in a sense of meritocracy in measuring the performance of salespeople, strengthening our foundation in seeking bigger opportunities in the cost competitive outsourcing areas. All these things, I said it will take 9 to 21 months. In other words, we will start seeing visible results, hopefully, by the first or the second quarter of FY15, FY16. Hopefully by the first quarter, but it could be second, third quarter. The third area that I outlined on June 15th when I gave my AGM speech was in improving our software delivery effectiveness. We are moving from our earlier focus on project-based performance, purely team-based performance, to both team and individual-based performance, so that we can recognize and reward high performers. Therefore, there is tremendous focus on measuring and improving individual productivity. We are re-energizing our employees as well as other levels, as well as the leadership, in bringing a better focus on meritocracy with a strong focus on improving the quality of hiring quality of training, and in retaining the top talent. As I said on June 15th last year, this is the toughest problem because this impacts 150,000 employees. Therefore, it will take anywhere from 18 to 36 months, and therefore we will hopefully start seeing visible signs of impact of this initiative from Q3 of FY15, FY16. So therefore, there is nothing that has changed between what I mentioned on June 15, 2013 and what I'm mentioning today. And we believe we are on the right path. We believe that we will move towards our aspiration of becoming the most desirable company from the perspective of every one of our stakeholders. Yeah. And as I said, now let me get to another issue which has been raised several times. I've discussed this earlier too. That is the management exits. First of all, this company, thanks to its Leadership Institute, in fact, we are the first ones in the entire country, in every sector, to start a Leadership Institute. We have 3 tiers of leaders. There's a lot of focus on training them. So therefore, I must categorically say that we have a considerable depth of leadership available within Infosys. Second, we conducted a survey amongst our customers, and we were very, very pleased to note that almost 100% of our customers said that the quality of our software delivery, the level of our service response, the speed of our response, none of these has been impacted by these exits. Third, having a few exceptions, by and large, most of the people that left us were not adding critical value to the company. We wish them best. We want them to succeed, because at the end of the day, they were part of this wonderful journey. There were times when they added significant value to the company. Therefore, they will always remain our friends, and we want them to succeed. We want them to be happy wherever they are. Now, the final issue is the CEO succession. Mr. Shibalal is completing his 60th year sometime on March 5th or so next year, 2015. So therefore, we will ensure that there is a new CEO in place by that date. We will ensure that the new CEO has all the support that the board and I can provide him or her. As you people know, we have had some changes in the internal board of directors with Ashok and Balakrishnan leaving. Ashok to join a smaller company as the CEO and Mr. Balakrishnan to pursue his interest in other areas. Over the next 12 months, you will see some more exits because Mr. Shibulal is retiring in March 2015. Mr. Srinath Bhatni is retiring in November 2014. And Mr. Chris Gopalakrishnan will be retiring in April 2015. Additionally, we have also had changes in the external board. Mr. Deepak Satwalekar left last November, that is November 2013. Mr. David Boyles completed his term of 9 years in January 2014. Omkar should be completing that term sometime in December 2014. So therefore, you will see some changes both in the internal and external board. One thing I can promise you people, and that is we will continue to be truthful to you people. We will follow the adage, let the bad news take the elevator while the good news takes the stairs. We will early and proactively bring bad news to you people because we want to be remembered first as honest and decent people and then perhaps as smart people. That philosophy of Infosys will continue, and we will always bring whatever bad news that could be there to your attention first. Let me stop here, and I'll now request Mr. Shibulal to speak.
Good afternoon, everyone. Once again, let me welcome all of you to Infosys. After the board meeting over the last 6 to 7 weeks, I have traveled extensively. I have had chance to interact with many clients, in fact, about 34 to 35 clients, as well as chance to interact with the client-facing teams. So I started my journey in Davos, and I have been there many years. The last 2 years, other than this year, Davos was very gloom and doom. Whereas this year, in Davos, I felt that there was a sense of confidence. Actually, by the time I finished my travel, in my mind, that sense have come down. Regarding my client meetings, number one, our relationships with our clients are very strong. They are extremely strategic to us and to our clients. And our delivery continues to be excellent for our clients. Let me start with industry updates. In financial services, clients continue to look at reducing cost through optimization and offshoring in their operations. The savings they get from these reductions are being channeled into regulatory compliance and risk-related initiatives. These areas, regulatory compliance and risk-related initiatives, are areas of strength for us. Our manufacturing consists of various subsegments: auto, aerospace, high-tech, and industrial. For us, high-tech is the largest. Auto sector is doing well, driven by record auto sales. Aerospace and industrial are stable. High-tech continues to face headwinds due to various reasons, one of them being reduced PC sales, another one being reduction in overall CapEx spend, including areas like networking. As I said, high-tech is the largest subsegment for us within manufacturing, and weakness in this segment impacts us. Now let me give you some color on retail. There has been sluggishness in retail and CPG over the last 2 months. Various reasons. Aggressive promotions and discounting during the holiday season has created pressure on retailers' bottom line. This is likely to cap their overall spending in calendar 14, CY14. Slowness in emerging markets has caused retailers to reduce their growth expectations, overall growth expectations. Some of our retail clients had specific business issues, leading to reprioritization of budgets. Recently, US retail sector has been negatively impacted by the harsh winters, which may create further spending pressures in calendar 14. At a broad level, some of our clients have seen slowdown in their business. This is across various industry verticals, leading to unanticipated project ramp downs and cancellations of our projects with them in Q4. We have also seen some challenges with skill mismatches between skills that clients need and what we have, and that has led to slowdown in ramp-ups. Now, these factors are leading to decline in business momentum for us during the quarter. At the beginning of the quarter, we provided a revenue guidance of 11.5 to 12%. The above factors may result in our revenues to be near the lower end of our FY14 guidance. Now coming to FY15, it is early to provide estimates. We are in close discussion with our clients. We expect to complete the planning exercise over the next 1 month and to complete it by the time we are into Q4 results. However, we believe that many of the factors that have led to the recent slowdown will continue to impact our client spending, at least in the initial part of FY15. Also, if the growth rate in Q4 is lower than expected, it will set the base for FY15 and may impact our FY15 growth rate. As Mr. Murthy mentioned, we remain focused on executing our strategy as well as the new initiatives. We are working very hard to meet our aspirations. We continue to accelerate our focus on various areas, Number 1, improving software delivery effectiveness. Number 2, winning business in traditional services. Number 3, increasing win rates in large outsourcing opportunities. Number 4, cost rationalization. Number 5, becoming more price competitive. Number 6, increasing sales bandwidth, thereby deepening our relationship with existing clients, as well as increasing the number of clients, that is, improving the breadth of our clients. And lastly, making the organization truly meritocratic. While we saw some initial results of our efforts in the last few quarters, we expect near-term performance to be choppy. We expect that it will take 3 years to attain our aspirations, as Mr. Murthy said, and we are only 9 months into this journey. With that, let me thank you once again for this opportunity to interact with you